Hello, everyone. I'm Brien Lundin, and I am here for our webinar with the Discovery Group, a partial representation of the Discovery Group. Now, I publish Gold Newsletter and host the New Orleans Investment Conference, if you aren't familiar with me. And I recommend a number of junior mining companies. Gold Newsletter is the oldest precious metals advisory in the world, and we have a great track record of presenting high potential companies, especially in gold bull markets, obviously, where they tend to outperform. Among the companies that we recommend are a number of Discovery Group companies. And what I like about this group is that I'm very familiar with a number of the principals in it, going back literally decades, and far too long for some of us to like to admit, to comfortably admit, but a lot of years. And we've gone through a lot of cycles of a number of the people in this, the principals in this group. And what they've done is put together kind of a loose affiliation of companies that share goals. They share a belief in good management, good projects, and the ability to finance those projects and maximize their potential. They've enjoyed an extraordinary track record. They've made a lot of money for Gold Newsletter readers of the companies that we've recommended within the group. I recommend, coincidentally, all three of the companies that will be featured today. Today we have John Robbins, who is a co-founder of the Discovery Group, who has a number of big successes in his track record. Jim Paterson as well, co-founder of the group, who has been very successful and a member of a lot of the teams that have enjoyed great success. Chris Taylor of Great Bear Resources, which we were thankfully in Gold Newsletter on very early and has made an awful lot of money for our readers, but has a bright future as well. And I know a lot of people are eager to get some updates from Chris on this amazing discovery story. And we have David Terry, who's taken the reins of Genesis Metals, a company that I have recently re-added to the Gold Newsletter portfolio for reasons that we'll explain, but they have news coming up and I think an extraordinary project. So what I'd like to do, kind of our rough agenda, is I'd like to make a brief presentation, give you my macro picture on what's going on in precious metals in the junior mining stock market, and why this is such an opportunity, why COVID-19 pandemic, as terrible as it is and has been for the world in general, and especially for those who've been directly afflicted by this disease, it has created a situation, economic situation, that is extremely compelling and essentially brought forward a major multi-year bull market in precious metals that we had been expecting to begin with. I'm going to invite our panelists today, as I do my presentation, to interrupt or add to my presentation, my macro presentation, if they like, hopefully with complimentary comments. But if you don't like what I'm saying or disagree, I think you're going to agree, but if you disagree, please don't hesitate to join in. So I'm now going to share my screen and get my presentation up, and here we go. I lost my screen sharing. Here we go. There we go. The new metals bull market coming at us fast and hard as a result of the COVID-19 pandemic. My thesis has been that a new round of massive stimulus was already baked into the cake. I had written in February and March in Gold Newsletter that the coronavirus isn't the reason for the next round of currency creation. It's just the excuse. It affects only the timing. Of course, it's a very valid excuse. It's a real thing and totally justified for many of the actions that have been made. But the timing was not only brought forward in terms of monetary stimulus, but the implementation was accelerated. Basically, I had expected a lot of the things that we're seeing right now to unfold over the next 3 to 5 years. In fact, much of it unfolded in 3 to 5 days. So everything's coming at us hard and fast. It's all on turbo mode, warp speed, and we have to get ready for it, and we have to be able to react for it and get positioned for it. Here's a chart of total Fed assets. And as it's hard to see from this chart because it looks exponential, but this has already slowed down. It has slowed down to the increase in Fed assets, which was around 4 trillion just a few weeks ago, and really well under 4 trillion by last August. Is
Brien,
now
what's the time scale on the bottom of that chart, just so I can understand it?
yeah, that
weeks?
runs from the end of QE3 in basically the end of 2014, and you see that it's flat for a long time. Then this gray area is the unwind. This is where the Fed tried to bring back this massive asset creation, and they were able to take 679 billion off of their balance sheet. But then they, surprisingly to a lot of people, weren't able to do anymore. The stock market started to pitch hissy fits, and that's part of my theme as well, that the markets are addicted to easy money. They're not only addicted to easy money, but like an addict that is addicted to a drug, they've developed a tolerance to the drug. So the markets not only need easy money, they need ever easier money. And at some point, I expected this year they were going to go back to the Fed and ask, by dropping 1,000 points or so, they were going back to the Fed and demand another round of rate cuts. And the Fed actually had started to cut rates. In late August, basically early September, they had started to increase their balance sheet again. And then, of course, as you see, we see the COVID crisis in that exponential rise. Now, at the very early stages, they were increasing their balance sheet amazingly by about 500 billion, $500 billion a week. Now they've slowed that pace down to around 80 billion a week. Now that sounds, in relation to what they started with, to be much slower. But when you remember the QEs, the previous QEs post 2008, they were doing 60 to 80 billion a month. And now they're doing 80 billion a week. And as Fed Chairman Powell recently said, he's perfectly willing to do much more, and they don't need to worry about the federal debt at this time. And that's the issue. Not so long ago, just actually a few weeks ago, I was writing in Gold Newsletter about how the federal debt was out of control. We were about 22.5 trillion. As you can see from the screenshot on the national debt clock, it's over 25 trillion right now, and going much higher. The federal budget deficit, we were talking about how that was out of control. We were back to trillion-dollar deficits in the U.S. as of fiscal 2019, and we were projecting trillion-dollar deficits going forward. Right now, and we are just in May, the federal budget deficit is 2.6 trillion. The Congressional Budget Office is estimating that it's going to come in at about 3.5 trillion. And when have we ever seen the Congressional Budget Office to overestimate the deficit? So I expect that that's the under, and I'll take the over on that. I think it's going to be much more.
And I guess a point on the debt per taxpayer, which is a really excellent number, because people that don't pay taxes aren't actually paying the debt back. It's those that are working. As the more people lose jobs, then that debt per taxpayer number would go up, would it not, significantly?
Oh, absolutely. And if you look at the bottom, the federal debt to GDP ratio, and keep in mind that the IMF and the World Bank say that if the federal debt to GDP ratio gets above 70%, then that's a warning flag. That's, that's a sign of a significant currency depreciation to come. And we zoomed through that it was around 105% of GDP for a long while, and now it's surged really over the last few weeks to 117% of GDP. And keep in mind that this is estimated as to the GDP number is backward looking. So we're going to have a much lower GDP going forward. So you're going to see that 117 number really accelerate by the end of the year when we get more accurate GDP numbers. And the GDP, it has been estimated that third quarter GDP is going to be down as much as 20 to 30%. And these are Depression era levels.
Well, Brian, there's a question for you. Like, if you look back to, say, World War II, how would this picture have looked after all the spending related to having a major world war? And how did they get rid of that debt in the end of the day?
Great point. And what we had back then were similar debt issues, but it was a different world back then. We didn't have this entitlement spending. You know, the entitlements, we're looking at this federal budget deficit at 2.7 trillion. We'll look underneath it at federal budget deficit actual is 3.9, 3.2 trillion. The difference between those two numbers is off budget entitlement spending that comes in at 500 billion or so every year or more. And it's just automatic. It's just there, it's off budget. Of course, we would all go to jail if we ran companies with this kind of a bookkeeping system, but it's off budget. It has standard built-in increases every year. And so that's why the actual increase in the debt is more than the sum of the deficits. Now, getting back to your point, post-World War II, we didn't have this entitlement system. Social Security was actually, fiscally healthy because there were so many more younger people and not that many older people. So a combination of the demographics, people living longer, the entitlement system, growing and growing welfare, Medicare, Medicaid, et cetera, means that we can't get back at, we can't address a debt this large. We can't get back to normal. In fact, these situations just accelerate. And it gets worse, because when you get debts this large, then you have to service those debts, and that puts restraints on interest rates, which I'm about to show you. Now, interest rates, one of the other things that the Fed does is not just expand its balance sheet, but the typical response to an economic slowdown is to reduce interest rates. And what we saw, I cut off the 1970s here because that was kind of a crazy era. But that was the first era when the Federal Reserve was unrestrained by a tie to gold, so they could just spend and go crazy, and they did. And we did, and so they tried to restrain that in when Volcker got in and really hiked interest rates to reduce inflation. But what we see here is once they kind of figured it out, they responded to every economic downturn with a policy of lowering interest rates, and it worked fine for a while. As you can see, in 1980, and we had these recessions and some economic downturns. And in response to every economic downturn, there was a campaign of rate cuts. But after every campaign of rate cuts, the next return to normalcy or attempt to get to normalcy never got past the previous high. Not only that, but the next rate cut would have to go lower and lower. And so it's a stair-step pattern that the Fed, addressing every economic slowdown, has cut rates to the point where, obviously, post-2008, we got to zero. Now, I originally showed this chart way back in March, early March at PDAC, the big PDAC conference. And of course, we were up here, and I had this bar saying the next time we go down, we're going to go down into the basement. The stair step has gotten down to the foundation, the basement doors open, and it seems hard to believe that the Fed funds rate will actually go negative. But keep in mind that negative interest rates in general, quantitative easing, a lot of the things that we're accepting these days, pre-2008 was crazy talk. And now crazy talk has become normalized. So I'm not discounting the possibility that the Fed can actually bring the Fed funds rate to negative level. But regardless, we're going to see negative interest rates in the US at some level, where at some treasuries, short-term treasuries will likely be negative. And more importantly, we're going to have negative interest rates. The reason for this is that the debt is so large that we cannot afford to have real rates of any positive consequence, because the cost of servicing that debt would lead to $1 trillion or more annually just to service the federal debt. I think that's politically impossible. So what we have is a situation where the Federal Reserve has to have a situation of negative real rates. In other words, inflation will have to be greater than the cost, than the inflation or the interest rate on the federal debt. You'll have to depreciate the currency more quickly than the cost, the interest rate on the federal debt. Otherwise, these costs would crater the federal budget. So we're going to have negative real rates. There's actually no way that we could have consistently positive real rates, in my mind, going forward with the debt this large. This is a great chart from Incrementum AG, the guys that put out the In Gold We Trust report every year, which is, in my mind, the best annual significant report in the gold market. But what they've done here is shaded some areas where we've had negative real rates. And these are these blue areas. And as you can see, this gold line going up, these are the times when gold outperforms. In fact, real rates are the most, have the strongest correlation of the gold price of any indicator I've ever seen, and are essentially the thing you really need to look at. And if we have a negative interest rate environment, it's going to be bullish for precious metals. I'd like to just get into the gold price specifically right now and show you that there are some parallels between this crisis and 2008. There are some differences though. The 2008 crisis was a financial crisis. A lot of the monetary stimulus was corralled within Wall Street and didn't get into retail price inflation. Much, if not most, of the monetary stimulus now is aimed toward Main Street. We're talking helicopter money, direct checks to American citizens. It will be inflationary, and I think it needs to be to keep gold moving this time around, but it's going to happen. But still, what we've seen is that during the 2008 financial crisis, we had tremendous volatility in the gold price, tremendous drops as investors, speculators had to sell gold to raise cash to meet margin calls, and it went back and forth, tremendous drops, tremendous buying, a lot of volatility in the initial days following the crisis, in the midst of the crisis. But here's what happened. Fear turned to greed. Investors bought gold in reaction to the policy response, which was an unprecedented level of monetary stimulus. Keep in mind that at this point it was unprecedented. Those precedents have been broken now and today in what we're seeing. But what happened was the gold price from a low of around $700 essentially more than tripled eventually to over $1,900. It steadied. Investors started to grab onto the theme of massive monetary stimulus, and they started to buy gold. Still, there was some volatility along the way, but that trend line was tremendously profitable for gold investors and investors in mining stocks. Looking at our final chart here, I wanted to bring this up because I get these charts from the chartstore.com. My friend Ryan Grease runs that site, and it's just a great source of charts. One of the indicators I like to follow with him is the 14-week stochastic, but occasionally he also publishes a 14-month stochastic, very long-term, that shows the big swings in the market. And if we look back in the early 2000s, you'll see that we had an initial burst off of 1999 lows in this 14-month stochastic, a drop back down, and then a big rise. In this period where that stochastic, that long-term momentum indicator, stayed at a high level, was tremendously profitable. And all of the gentlemen on today's call can testify to that you had junior mining stocks that you had a rising tide that lifted all boats. So if you got in early in a very good company with good management, very high likelihood that that stock would double, triple, even quadruple in price. Along the way, you also had stocks that went up 10, 20 or more times in price. And when you have that kind of performance extended over years, then you have people who can buy a stock, have it multiply, have an exit in that one, get in another one that then multiplies in price. It's needless to say, it's a highly rewarding scenario. Here we see that we had a similar scenario off that bottom in December of 2015. We had a rise in that long-term momentum indicator. Then we had another drop back down. Sorry, I got out of this somehow. So let me get back to it. Back to the last chart.
Nice save, Brien. Nice save.
Yeah. Anyway, I'm gonna keep it on this just so we can get to the last chart. But what we have here is another drop down in 2018, and now a big rise again. And what I anticipate is that we're going to have another long-term period, multi-year period, where we're going to be above at the high level on this long-term stochastic. So we're going to have a long-term momentum maintained in the gold market. And we're going to have a similar period to this where there are going to be just an awful lot of profits made in junior mining stocks if you get into the right companies. Now I'm going to try and unshare my screen and get back. If I can unshare that. Okay, there it is. So here we are, back at with our panel. Now, I'd like to see what you guys think about this. Jim and John, you had some ideas as we were talking about this. What I'd like to do is get your views on this long-term picture, but Brien, try and bring it down a little bit more to your levels of real expertise in the junior mining share market. And I know that you can appreciate what I was talking about in those early 2000s when we had that kind of a long-term upward momentum in the gold price in the junior markets. Can you give me your impressions on if you think we're in that kind of a position? And then further to that, I'd like to get into the lessons we all learned during that period. It's hard to go wrong when you have the market working for you, but it can go wrong if you pick the wrong stocks.
You want to start, John?
Well, maybe I'll jump in there. I guess, I've been in the mining business for about 35 years now and experienced my first market crash in 86, 87, I forget, Black Monday. And we've seen a lot of these crises come and go. Through that time period, I would have to say that I would never have considered myself as a gold bug. But I have to say that my sentiment has changed over the course of the last few years, and a lot of your charts kind of demonstrate, the situation that I think we're in globally, and in particular, I guess, the situation the U.S. is in with the debasement of their currency, the growing debt, and now with this COVID crisis and the unprecedented amount of stimulus and debt that the governments are taking on. I don't see how you can have anything but a positive view towards gold. I'm also a big fan of base metals as well, but right now I think gold is definitely, and precious metals, a place that you have to be in, because it's the only real hedge against the destruction of the value of our currencies.
Yeah, and that's been proven not just over that past 40 year or so time frame that I showed in those charts, but one of the things I stress to people is that nothing is new here. We're the same as same human motivations as people in ancient Rome and ancient Greece. In the Roman Forum, there was probably a Rick Rule walking around in a toga talking about how people need to sell now or whatever. And but it's all, human nature is the same throughout human history, and civilizations have always done this. They've always overspent, they've always created debts, and they've always depreciated the underlying currency to cheapen those debts. And so it's nothing new. It's what has always happened, and it's going to happen now. Jim, your thoughts? thoughts on this?
I'm still thinking of Rick Rule in a toga. I'm kind of shocked.
Yeah, I'm sorry to throw you off
Why
on
did
that.
you bring that up? Why did you bring that up, Brian?
Can't get off of that, can you?
Yeah, let's move on. The point I really struck home with me is particularly working with John early on in the 2000s was that because of the expertise of John and the strength of the group, we were brought projects early by people that wanted financial partners or to work with us. The capital partners came to us, like the brokerage firms that kind of approached us first with capital, and we almost had sort of an accelerator. So it is possible to have outsized gains in a rapidly upward moving market if you are involved with the right group. You kind of attract projects, capital, people, and you can actually have some pretty, you can amplify your gains. You know, the term in a high tide, all boats rise is true, but some rise higher and sail faster. So that's what I like about our framework. And there are other groups like ours around the world, in Australia and maybe Sydney, Perth, London, Johannesburg, New York, Toronto, sure. But there's some really good groups that take advantage of when the tides have turned, they can really turn it on and make hay while the sun is shining.
Yeah, and you know, good management mitigates risk as well, and it is a risky business, so it covers your downside a bit. One of the things that I've been telling people, well, what we've seen in this market is that as gold moves higher, the producers have moved first. You know, they're starting to come out their quarterlies, and they're, you know, extraordinary profits, and they're going to be cash rich. And I'd like to get back to that theme actually in a bit. But they move first, then you get more to the junior producers, then the development companies. Eventually you go down the food chain, you get to the explorers. Have been recommending to my readers they need to get in the area we specialize in, find companies that have identified resources, large resources that have this optionality play, because they're going to move earlier. But I haven't been taking my own advice. I've been investing and putting a lot of money into the juniors, especially during that turmoil that we've had recently, where prices were really driven down to the rock bottom, because we've seen these kinds of cycles before, and we know the macro picture moving things higher. You have to kind of jump on these prices. And I know these stories so well that you can kind of take advantage of the inefficiencies in the market. And it is an inefficient market. So like you say, if you go find a group, find a story, get to know it well, you have a real advantage over people who say don't know how to do that or don't do their homework. So if an investor,
I would jump in and say it's really tough too to differentiate, because if you go to a mining conference, for example, and there are several hundred booths, really they don't look that much different. So how do you tell the difference between a good project and a bad project, a good team and a bad team, just looking at the storefront? So I think that you're right. So the efficiencies of understanding the group and having a deep level of knowledge about the group really pay dividends when you get a market crash and you go, shit, this thing, excuse my language. When you say a month ago, this is the price of the, apologize. It's going to get worse probably too. You know, if you understand the valuation as at 3 months ago, and then that goes down 30%, you're very comfortable with the story and you understand it, and you go, this is a good time to take advantage of it. You are a much more efficient investor.
Yeah, that's a good point, because you know, I look at the discovery group, and I have, you know, dozens of companies every week trying to get a phone call with me and look at their company, and I talk to as many as I can. But if it's a new discovery group venture or one of a few other groups out there that have a track record of success, and I know that they've already covered all the bases, you know, I'm taking that call. I'm learning about it. I'm trying to find out what their next deal is. John, could you give us an idea of that then? If there is a checklist, if there is something, what do you look for? What would an investor look for in a company if they want to start differentiating, if they're starting from ground zero?
Sure. Well, I guess, you know, first of all, in a market like this, if you're extremely risk adverse and you know, you're happy with a modest return, I mean, you can buy Newmont. It's probably a pretty safe bet right now in a rising gold market. It's going to make lots of money, but you're not going to see an investment like that most likely double or triple. That torque exists really in our space, in the junior mining space. And, you know, we, within our group, look for companies that have solid projects, good people, but even outside of our group, I mean, we make strategic investments, and we apply the same rationale to that. We look for quality projects, but they have to be backed with solid people. And on the project side, you need to have grade. Grade is king. There's no point wasting your time looking at a project if the grade isn't there. Grade gives you torque. It gives you resistance to a downturn in a market, and it gives you tremendous leverage when times are good. And you also need scalability. You want to look at projects that have the ability to grow. They've got to have good exploration potential. That's where people come in. You have to have good technical people to take you along that path. And then you also have to look at the commodity space. And I think it was Murray Pesum years ago who coined the phrase. He said, if the market's looking for blue ties, don't try and sell them green ties. And right now we're in a hot gold market, and you know, that's one of the things that we're kind of focused on, is looking at good stories in the precious metal space, because for the foreseeable future, gold is going to be where it's at. The other thing is on the people. You need to have people that are very have strong sense of integrity, good technical strengths, good access to capital markets. And then the other thing is to look at their track record. You know, or is this somebody who's never done it before, or is this a group that's had success after success? Because typically, groups that have a track record of success continue to have success in the future. And I've seen, you know, good projects with bad people, and the projects and the companies never really move forward. They underperform. A good project backed by solid people with a track record of success is pretty hard to beat. And that's where, if you find the right company, you will see the chance to double, triple, or get the elusive, you know, 10-bagger by looking for those kind of opportunities.
That's a great point, John. And I think that as we develop this kind of a checklist, and you look at the things that are important, like management, technical ability, the project grade, I would throw in there size of the project as well. There's no reason to waste your time. It's a target-rich environment. There are a lot of options out there. There's no need to waste your time on something that's very small, that doesn't have the ability to grab headlines. But all of this kind of works into a blend, and in some cases, one aspect will override a weakness in other areas. In your own group, you know, you're focusing on gold, but fireweed zinc is one of the best, I think, base metal exploration / development stories out there. But it's a cycle kind of a thing. You know, you have to, time is money. You have to pick the bottoms and be a value investor for those sorts of things. Your group is focused a lot on exploration, but you've also saw an opportunity in Bluestone that was a development play with a bit of an exploration angle to it. And of course, that's worked out very well. So you can't blind yourself, I guess I'm saying. If one aspect of a venture or a company is so exciting, then you can't lock yourself away from it or be blind to that overpowering some of the other aspects of the market.
Yeah, you know, as I mentioned earlier, I'm still a big believer in base metals. I mean, the economy revolves around copper and zinc base metals, but it's all about timing the cycle and looking for great opportunities, because zinc and copper will have their day, and probably not in the too distant future. So that's a great time to be, so-called bottom fishing or looking for those opportunities, but you might have to have a little bit longer timeline as an investor, to realize the big returns.
Yeah, and that's, you do have to, and you have to learn how to play those cycles. But there was a compelling supply-demand story in the base metals area, zinc and copper, before we went into this, and now there's been a tremendous amount of supply destruction, of course, demand destruction as well. So it is a timing thing. I'd like to just take a moment to stress to our audience that we do have the opportunity to ask our panel questions. We have you have a window on your screen for asking questions, and I would encourage you to go ahead and do that because from what I can see, there aren't any questions there yet. So we're going to get to the Q&A in a bit. So if you're in there quickly now, you have a much better chance of getting your question answered during our time constraints.
I'd like to throw a point in on people though, and I think Rick Rule said it best. I'm not sure which interview he was saying it, but it was struck home with me is relevant experience, not just experience. For example, if you are a PhD and you've written a dissertation or you've written a big paper on copper, it doesn't make you an expert at copper exploration or running a copper exploration company. And if I look at David or Chris on the line, they're both highly educated men who also have a tremendous amount of industry experience, sitting on drill rigs, negotiating deals in South America, running companies, raising capital, going through cycle ups and downs. And so this is highly relevant experience for their current roles. And I think that's a big thing about Discovery Group too, is we have people in positions, executive positions, that have stood the test of time, weathered the storms, had success. They're super driven. They're really focused on doing high quality work. Their integrity, or the perception of their integrity, is very important to them, and that's why they're in the group.
Yeah, and I think one of the reasons that Rick talks about that so often is because you don't necessarily want an exploration group operating a mine. It's one of the clearest examples. I don't know if any of you gentlemen would want to operate a mine. It takes a different skill set. And in the exploration business, one of the things that's hit me over the years from the outside, being a newsletter writer, but also on the inside in a company or two that we've founded, it amazes me the skill sets that a junior mining executive has to bring to bear. That it's not, you have to be a Renaissance person, as it were. You have to be able to handle the financial end, the fundraising end, obviously the technical end from a geological standpoint. You have to manage staffs, manage people, and then there's the promotional end. Promotion is not a bad word in the junior mining sector. You have to be able to get eyes on your story and have a good story to tell, which a part of it is getting the project, getting the team together, having a good story to tell, and having somebody who can tell it well. And all that has to come together, blend together to in a pretty complicated recipe to create a success. Wow, I see our questions are starting to come in now, but before we get to that, I'd like to go to each of our individual company CEOs and basically ask you, how does your company measure up according to this kind of general checklist that we've had? Chris, you've had a just tremendous success. I call it a generational discovery with Great Bear Resources. You've just got to be like a kid in a candy store right now. I guess you grew that beard so people can't see the ear-to-ear smile that you're walking around with quite as easily.
I'm a natural poker player, so I need something to conceal this part of my face.
Well, you need it because you just came out with some drill results. And I guess that, looking at Great Bear, I look at you're checking off all the other boxes: management, technical expertise, getting the story out there. But boy, it sure helps to have a real discovery, doesn't it?
Well, Brien, like you know, let's think for a second. You were one of the first people that covered Great Bear. If somebody had put in, let's do some math on it right now. If somebody had put in $10,000 when you made the original recommendation, what would that be worth today?
Over $250,000. So
It's
Not bad.
incredible.
there you go.
And it shows you like what's really struck me during this last cycle is just how a good story, you know, like you guys are talking about. I appreciate it. We can all recognize that we have a good skill set. This has been the best group of companies and people that I've had the privilege to work with overall. But something like a Great Bear story, for instance, if you had bought the stock when Brien originally recommended it, you know, your 30-cent recommendation would have materialized into you know, something over $10 Canadian per share. And then you also, if you believed in gold and you believed in the market cycles that Brian's talking about, and John and Jim have touched on as well, you could have bought the stock as low as $3.75 just a month ago, and today you could have sold it for, you know, $10.50 or something like this. And when you take that long position and you base it on a good team and a good asset, even if you hit a rocky road like we've had with the COVID situation, there are trading opportunities around these events, and the opportunity to grow at any point in that cycle remains. So it's impressive. I know we are a leading story, but it also highlights how you have to listen to people with industry experience like John, like Jim, like David, like Brian, and take their recommendation to navigate through the forest of other available opportunities.
Well, that's great in a general standpoint, Chris. And as you're talking, I'm looking ahead and some of the questions coming in. So I'll anticipate some of them. Can you comment on your latest drill results and the spin-off and all those exciting things that are happening in Great Bear? And what I'd like to see if you could address a bit is people look at this, these results, and very consistent mineralization over 4 kilometers in strike length, just huge. And I would add not closed off in a lot of on echelon areas for potential. And that's still not even looking at the hinge zone, which is the high grade, typical more Red Lake zone. So it's, you know, and yet there's more over and over again. Can you talk about the relevance and implication of the last round of results? And if you could address, for me at least, your thoughts on the geometry of the deposit, because as I understand it, it's very vertical, or it's essentially vertical. Comes to surface, although you're stepping back and you're hitting it at depth. What are your indications of the geometry to surface and how it would translate eventually and potentially into open pit versus underground mining scenarios?
Yeah, no problem. You know, this has been a very important few months for Great Bear, because when we found this LP fault discovery on the project, we basically ended up chasing the gold into what people would have thought of as the wrong geology. So just about everything in Red Lake, all the mines, 30 odd mines, 30 million ounces of production, are in one package of rocks. This is in totally the wrong package of rocks. So there were some predecessor explorers on the project that put holes into it, and they didn't even assay a lot of the core that actually hit this zone, because it doesn't fit the model. Whereas our lead geologist on the project, he's also a director of the company, Bob Singh, didn't care about what the prevailing wisdom is. He's a guy that definitely thinks for himself. We all do here in the Discovery Group, but Bob's an exceptional example. Followed that gold, and we began to hit this system over step outs of 1 kilometer. Each step out was like 1 kilometer. We did it again, and then again, and then again. And that's really remarkable in a high grade gold story. You know, I'm just ballparking this, it's just an opinion, but I think that the average strike length of a high grade gold zone in an orogenic system tends to be something like 100 meters, maybe 200 meters, usually smaller than that. Whereas we're dealing with a single zone that's more than 4 kilometers long. So naturally there was skepticism early on when we hit it, you know, on these big step outs. As we began filling it in over the intervening year, it's only been a year since you put a hole into this thing, period. You know, the fill in has been showing continuity. The continuity has been going to surface. And like you mentioned, Brian, you get a panel like gold zone that goes right to surface down to whatever depth. It'll probably go many kilometers of depth, and it has significant widths. Like in that area, usually mining is something like 1/2 meter wide gold zones to maybe 2 or 3 meters. We're dealing with something at this LP fault which is up to 300 meters wide in terms of gold zone. So it's an order of magnitude or 2 orders of magnitude larger than what people are used to seeing. So I think that it has very good prospects for from surface bulk tonnage mining, whether that's an open pit or underground bulk tonnage mining. We don't know till we do the studies, but you always want your gold to get to surface because it's cheaper to get it there. And what kind of gold do you want to get to surface? High grade gold. And we see that section after section and these wide, kind of mid grade and low grade envelopes around that. So, we want to prove what you just said. We want to prove that it is a generational type discovery. So that's why, this year there's 300 holes going into that target, is because it's only with data that you cut the speculation and separate it from reality. And we want to show the reality of the size and continuity on this thing.
So what you're talking about is it all culminating in a resource estimate at some point, so that you'll have a baseline value to show the market and I would assume at that point still more growth potential.
Yeah, the resource, when you have something this size, like if I think you want to compare apples to apples in this business to give investors a rough idea what we're dealing with, like the biggest mine in Canada is the Canadian Malarctic open pit, which is 3.5 kilometers long. Already at the LP fault, we've drilled off 11 kilometers along that target, and we have gold in every hole. The best part of it is probably going to be this middle 4 to 5 kilometer area, which if you think about that, stack it up against the biggest deposit, which is 3.5K long in a pit. I mean, you're looking at something that could be very large. It's just, it takes a long time to drill off a target that big. We've had 5 rigs. We're down to 3 with this virus situation, but it's still going. And it's going to take us to drill the 300 holes that we wanted to do this year all the way to December to do that. So we'll deliver a resource next year at some point, an initial one, but that's still only going to scratch the surface. Most of the mines in this area mine down to kilometers depth, like, 1.5 kilometers to 2 kilometers, even 2.5 kilometers is normal. And we're only giving you an initial resource down to 500 meters. It's literally just scratching the surface. So there's a lot of upside even after we put that number out in the public sphere.
And just an exciting story, and I'm glad to be an early shareholder. I'm glad it's made so much money from our readers, and we're in it to win it, and looking forward to watching this to its culmination with still a lot of potential appreciation still ahead. David, I'd like to move to you in Genesis Metals. Genesis is a company that I had recommended because I was familiar with the founders and had recommended a few years back. And a lot has happened since then. But in 2018, you released some drill results on your project that were not really appreciated by the market because the market was in the very unstable at the time, and if I remember, a bit of a free fall. And yet I look at those drill results. So I'd started re-looking at the company again over the last few months when you joined the Discovery Group, because again, that gets my attention. And then you are also taking charge of the company, which is, I've followed your career a number of times over the years. But then I look back at those results you had produced in 2017 and thought to myself, if those kinds of results were released in this market today, they would be headline making results, really great grades over really good intersections. And what you're doing now is you were drilling, 8 holes in before the COVID shutdown that are in the lab, and expecting news really at any moment, I guess. So you've got a real exploration near-term opportunity that I'd like to see if you could share with our audience.
Yeah, thanks a lot, Brian. I guess, just backing up, my sort of introduction into the Discovery Group, I've known Jim and John for many years, was with Great Bear coming in 2016, and I joined the board of that. And so this opportunity with joining Genesis happened last fall. So I guess when you say I mean, it's the company obviously did that drilling back in 2017. I wasn't involved in it at that point, but you're right. a number of the drill holes that went into the main zone deposit on the Genesis Chevrier property in the Abitibi in Quebec hit quite wide intercepts of high-grade gold mineralization. And you know, frankly, that sort of thing is fairly typical in these orogenic, structurally controlled gold systems. The drilling that was done by Genesis at the time, though, wasn't really targeting that style of mineralization. Most of the drill holes were fairly shallow and really focused on defining open pit, lower grade zone of mineralization. But a number of them did hit this sort of mineralization in, you know, what we call high grade chutes within the overall structural, you know, fabric of this controlling the mineralized zone. And so what we've done, and we did quite a bit of modeling over the last few months, aimed at trying to better define those things based on all of the old drilling data, structural data, and so forth. And we've tried to better define them with closer space drilling and look for expansion opportunities. So that's what we've done. We started that in February, late February, and we got 2,000 meters and 8 holes completed before the COVID shutdown. And we're expecting to be able to go back within probably the next few weeks and resume that program and get the other half of the core that we didn't get sampled yet, sampled and into the lab.
Yeah, you know, you bring up a good point in that there is fad and fashion even in the junior mining sector. And for so long, it's get the big low-grade bulk mining scenarios. And I think Chris and Great Bear did a lot toward changing the market's attitude, and now I've seen a reattraction, or, you know, coming back into fashion, high grade, higher grade. And of course, as John alluded to, high grade can cover up for a lot of other deficiencies, and it's harder to lose of high grade, especially over those kinds of intervals like you're talking about. And can you give us an idea of some of those previous drill results?
Because I think the one that really catches people's eye was 8.5 grams over 21 meters. So, you know, that's a good drill intercept by anybody's definition.
Yeah, and that's amazing to me.
There's a number of them, so.
And that fell onto deaf ears pretty much at the time. And in this kind of a market, that kind of a result, you know, I would assume, I would be very surprised if it wasn't market moving. And again, you've got core in the lab and results coming out soon. So that's more of a near-term opportunity. Probably a little bit more of a medium-term opportunity, and different than what we've been talking about with gold is ValOre, Jim's company, which he's put an awful lot of money in personally, by the way, at any and all prices, constantly on the bid until he maxed out, frankly.
Look at John's face. Look at John's face when you say that.
Well, look at my face.
Hoping that Maureen wasn't listening in.
I told you not to mention it.
Because look at my face.
Brien.
I tried to buy the stock during the downturn in March and April, and couldn't get any on my stink bids because come to find out,
lose, baby,
bidding a cent or two above me, and I didn't get near as much as I wanted to. But it's a PGM play, and I recommended this one from basically from the jump, because I know Jim for way too many years. Take that however you like, and I know though that his approach is a very serious one, and I learned about the project early on. It's in Brazil. It had a resource that previous owners had estimated at a considerably larger size than Jim's group, than ValOre is now estimating it. They came out with a very conservative estimation of the resource, which is over 1 million ounces of palladium heavy PGMs. And by decreasing that resource, they now have prime exploration targets to expand the resource once again, which again is already world-class, and some other exploration targets. So Jim, I hope I didn't steal all of your thunder with that. What's left to tell of that story?
Just that the overarching theme is that what I learned from the group was that for example, Northern Empire and Bluestone, where we utilized companies within the group to go after assets that had a considerable amount of money spent on them by previous operators, and not a lot of focus on exploration. which is what our group really, that's our wheelhouse. So I think that John would agree that those were two cases where the people that from which we bought the projects weren't spending money on exploration. And we recognized an opportunity in those two cases. And that's the same thing with Pedra Branca, where we recognized that we had the district scale potential. We had a lot of really high quality data. There wasn't a focus on exploration. That's what our group does. And we have a really good team that will be focusing on that. We have a program that we will be commencing as soon as safely possible in Brazil, and we're funded to do that. And it's exactly what we want to do, focusing on resource expansion, so you know the resource, but also hitting targets that have already been drilled, that have high-grade PGM mineralization in drill core, just never followed up. Those are great targets. And then we have a whole bunch of targets that don't have any kind of geochem on them, so they haven't been drilled or soil sampled, but we'd like to go in and sample those as well. So we've that really big discovery pipeline. So it's right up our alley. Great data, unloved a little bit, maybe not really focused on in terms of exploration, but we recognize how much value can be added with exploration, and our shareholder base loves that.
Yeah, it seems to me you have a very clear path to significant resource exploration, expansion, and significant exploration results. And you kind of soft sold your drilling plan. You said in the near future, literally next month, if the COVID crisis allows you, but currently your plans are to begin drilling next month.
In June, yeah.
Yeah, and the PGM area is one that has not, everyone's looked at it in amazement, especially palladium and its tremendous run before all this palladium, all this coronavirus crisis and everything else. People were amazed at the palladium bull market and what it was doing, and no one really predicted it that I saw. But what's happened there is that everybody was so enthused with electric vehicles and forgetting that there was a significant supply-demand issue in the PGM market, and that internal combustion engines were not going to go away. And in fact, that market was growing and still growing and would be for many years to come. So I look at it as there's probably a 2-year window of opportunity now for the PGM exploration plays to advance their deposits, get them all dressed up and put a bow on them, and look to see if the majors are interested. And I think you've got a fast track to do that in ValOre. That's why I've been buying stock personally in the market as well.
You're gonna get in front of me, Brian.
That's the problem. That's been the problem, because you are not price sensitive.
I'm agnostic. I am agnostic to that fact. Yes.
Open up that checkbook, Jim. Open up that checkbook. So let's look at some of these questions that we've got coming in, because we've got a bunch now. I only had to ask once. One of them is, do you have concerns about gold mining in non-swap lines nations? That's an angle
that's Marin Katuza.
Yeah, that's right. I was trying to remember who would come out with that. That's an angle they're coming out with, or he's come out with, to basically define countries that aren't the best. They don't get the kind of financial credit even by the U.S. Treasury and IMF and the global. Basically, is regime important for junior mining? And I think that we learned that recently. That's a point that's been driven home by PNG, Papua New Guinea, and essentially expropriating one of Barrick's jewels in their production crown. So let's look at that. John, why don't you come in, because I know that you're in a bit of a satellite delay up there in the great Northwest in your cabin. So we want to try and direct questions to you with some advance notice. What do you think about regime, and as a driving force in the discovery group, how has that influenced what the companies that you bring into the group?
Sure. Well, obviously, jurisdictional risk is something that every investor has to take into account. Most of our projects are in North America, although ValOre is in Brazil, and Bluestone, which is a company that I was involved in founding, is working in Guatemala, which Some people, have some pretty strong views about that jurisdiction. I think you have to look at every jurisdiction. You have to do your own homework and recognize that things change, and they can change rapidly, sometimes, to the positive, and as we saw in PNG, potentially to the negative. I mean, the PNG thing, there's going to be an awful lot of international pressure for them to reverse that decision, so we'll see how that goes. With that said, though, some of the greatest opportunities come from taking advantage of market misconceptions, and that's exactly what happened with Bluestone. We were able to buy that project, which had over 1 million ounces of high-grade gold, one of the highest grade undeveloped, fully permitted projects on the globe, and we were able to buy it off Gold Corp for $35 million. You just don't get those sort of opportunities in what people perceive to be safe, jurisdictions. And even what people perceive to be safe jurisdictions, look at some of the historical things that have happened in British Columbia over the years when we had socialist governments come into play that basically expropriated world-class deposits like Windy Craigie and made it into parks. So people have to be careful about just, broad brushing areas. I mean, there's areas that I'm sure, you probably won't see Discovery Group get into the Democratic Republic of Congo anytime soon. But, I have no problems working in Guatemala. We've been working there actively for 3 years now. We've raised over $200 million. Lucas Lundin is our biggest shareholder. There's a fellow who's never been too risk adverse when it comes to jurisdictions, and it's paid off handsomely for them over the years. I think you have to just assess every case on its merits and look at the opportunities, and sometimes the opportunities outweigh maybe some of those potential perceived risks, I would say.
Yeah, and I think just to add to that a bit is you do have to look at each opportunity, each company individually, and assess it as you say, but you also have to keep in mind what your time horizon is as a junior resource speculator, and that you're not going to be in this company or this country for 10, 15 years. Your typical time frame for a speculation in junior mining is 2 to 3 years, maybe 4 at the outside. And so your risk really is mitigated by the fact that everything just has to hold together for that amount of time, and not this super long time frame. It's going to be somebody else's problem if things do turn badly. And these are speculations, but boy, Bluestone has been a great winner for our readers, for me personally as well, because I bought into it as well with great grades. Moving on, we have a question on the general market as well. When is silver going to do something worthwhile? Well, how about today? You don't need to wait that long. Gold's up 2% or about $33 I just looked at, while silver is offering leverage to that. It's up 3.4% or about 50 cents. So yes, silver moves later than gold. It has an undeserved reputation as being primarily industrial. That hurts it when people are selling anything that is not going to benefit from a growing economy. Silver got absolutely trashed over the last couple of months because the majority of its demand is industrial, and people are looking at the economy and a global slowdown, and naturally it got hit. It had a target on its forehead, figuratively, and it got taken out to the woodshed. But if you have a long-term bull market in gold that's based on monetary issues like this one is, then silver will eventually catch up with gold and will outperform gold over the longer term. It's always happened. It's going to happen again. So I tell people, if you like gold, you have to love silver. And I think it's a great play. And if you're looking at silver, it offers leverage to gold. Silver mining companies offer leverage to silver, and junior silver companies, exploration plays, or small producers offer leverage to the regular silver mining companies. So you can get leverage piled on leverage on top of leverage. And that segues to another question where someone was asking for Chris if there is a silver component to the mineralization at the Dixie project that they never see it mentioned. And that's a great question.
Yeah, it is a good one. Dixie is almost exclusively gold. It's unusual in that sense that it has very low, usually with gold, you get, or frequently you get sort of a toxic metal component like mercury, arsenic, antimony. Those are almost absent with Great Bear, as is silver. So it's like a pure gold deposit in that sense. So metallurgically, that's a very positive trait. But it's very unlike what people would be familiar with from Mexico, other jurisdictions where you often get a lot of silver and base metals with the gold. Here in the Red Lake area especially, it's basically just gold, and our project is exceptional in that sense.
Playing off of that, one of our questions is asking for Jim that the previous owners of your Pedra Branca deposit in Brazil had noted or found significant quantities of nickel as well. Are you finding that? Is that something that has the potential to be a serious economic contributor to your projects? And beyond that, are there any other metals that you're finding?
I think at this point, we're really focused on the shallow high-grade mineralization. So that would be palladium and platinum. And what we've seen is that some of those base metals that the questioner was referring to are at depth. So our focus is not the base metals; they're fairly low grade. But it is, we'll be doing significantly more exploration in the project, and we'll be coming up with grades and assays, and those will tell the tale when we receive them. Short answer: we're not focused on it.
Okay. Now I threw a softball over the plate for you that you just let go right by you. In another question, somebody just sent in to throw that softball again. ValOre, the symbol by the way is VO, and has rhodium. Can Jim John comment on that?
Yeah, we did.
The market, of course, has been extraordinary and up and down, and not for the faint-hearted. But it is an extremely valuable metal. So can you comment on that?
Yeah, we did actually re-assay some pulps that previous operators had generated, and we came up with some rhodium numbers. We timed it perfectly, and Brian, you noted that I think rhodium was at $11,500 an ounce. We put the assays out, and within a week it went, because of COVID, the rhodium price cratered to $2,000 an ounce within 5 days. So you joked that we actually had caused the crash in the rhodium prices. But yeah, we'll be looking at that as we go forward as well. And that is a PG that we think will be important going forward to some effect. So we'll be asking for that.
That may have been less of a joke and more an observation, Jim, but take it as you will.
Yeah.
We have a question, a bad coincidence, but it is a significant value for that metal. And, and we'll see what the contribution may be. I'm trying to find the question right now that I was going to next. But basically, it was for David and John that the turnaround at Genesis from late 19 was stunning. And they're asking, how did it come together? Can we get a little bit of the inside baseball, behind the scenes story on that?
From the end of 2019, you're talking about?
Yes.
Yeah, basically, it was a combination of things, people, joining the team in various capacities, myself, but other people on the technical side, sort of a reinterpretation and relook at the flagship property, Chevrier, that was carried out, and basically a recapitalization and refinancing of the company. So those aspects all came together, and that's what happened at the end of 2019 and then on into this year.
And again, that you and the Discovery Group were able to see a project and a company that had great drill results and great upside potential that the market wasn't appreciating. And again, that gets back to my story, not to so much as promotion is important for junior mining company, but getting attention from the market. There are a lot of companies, there are thousands of companies out there, and you have to get people to look at your company. And one of the ways that can be done is with the discovery group, it immediately gets credibility and attention in the market. So it's a great marriage when you can have a good project, good people in a group that's going to naturally attract attention to it. Chris, I have a question for you. Chris, will the majors let you keep this project for over a year, or will you likely be bought out by then? If you can get it down to a week or two, you don't need to get too exact. Why bother with a resource which could make some people think that is the limitation of the project? Great question.
It's a dual purpose. I hope that nobody comes hunting the great bear gazelle, or I guess the bear that's roaming around in the savannah. We do sort of have a target on us. All I can comment there is that out of comparable deposits around the world, very, very few of them are operated independently of this magnitude outside of a major. So it is a possible outcome. So our job is to drill as rapidly as possible and make it as large as possible before something like that can happen. That'll capture as much shareholder value as possible. So that's really our mandate. And why would we do a resource? Effectively, we found a massive mineralized system. There's really no doubt about that. We have the drilling to show that that's the case, but people need to know what the internal consistency and grade distribution is. And as soon as we're going to show that, that's where we capture extra value for the shareholders. So when we put out a resource, it will only be a small fraction of the total mineralized system, but we will have already completed the drilling to show that the system is much larger than that number. So I don't think there's a lot of downside risk, and we will make it very clear. I think we're pretty good at communicating. We'll make it very clear that that's not the full story. And I think, you know, some of the drilling that we have planned, other targets, deeper drilling, these sort of things, they'll show you definitively that there's more going on than what is just happening in the area that we've already got the drilling done at. So we should be able to address that easily.
And that's an important aspect too, in that a company, when it sells or is looking to get acquired by a major, they want to have enough mystery left in the deposit to tempt that major to potentially, well, to pay more. And I think there's so many different ways you can do that with Great Bear. Also, you're sharing a lot more information than most companies do. I mean, along the way, the majors looking at this have the ability to essentially do their own resource calculations, don't they?
Anybody can. Any investor in the world.
Well, not me, but
Yeah, but anyone with modeling software can go onto our website, go to the data section, and download every drill hole into the LP fault that we've done, and that'll have all the highlighted intervals, and we even have DXF files on there that show you the outer boundaries of the system, so that you can get a pretty good feel for what the total size is. In a case like ours, we would do this anyway, but the more confident you are in the asset, the more transparent a company should be, because you're trying to highlight interest. You're not trying to hide something. Really, with the Great Bear, the LP discovery, the Dixie project, there's nothing to hide there. We want everybody to download it. We want you to look at the data, and because that's the story. Regardless of how much promotion or whatever we might do, the data and the results are driving the bus here. They're driving the value appreciation.
which is why that you've seen significant price appreciation in recent days as those results have come out. People are plugging those numbers obviously into models. We are a bit over on time, so I think this will be our last question, and I'd like to at least initially address it to John, because it's more of a general market situation or question, and anybody else who'd like to chime in, please do. How do you see the takeover trend over the next 12 to 24 months? Bigger companies, in other words, buying explorers. It really touches on what Chris was just saying. My view on this is that they're making a whole lot of money at these gold prices. They've got fat wallets right now, and there's still a lot of very undervalued companies out there with significant resources. But John, how do you think this is going to develop, and when do you think this is really going to get started?
Well, I guess the M&A and takeout space is always an interesting one to follow, and often it doesn't follow a logical path. When projects are the cheapest and the greatest opportunities exist, the big companies are loath to spend their money and acquire projects. Often they go through a period of contraction where the bean counters take over and the activist shareholders don't want them to spend their money. They go into a cost-saving space, and although there's great opportunities there, there's almost nothing in the M&A world. Then when the markets start to turn, these companies start making tremendous amounts of cash, and we're starting to see that right now. And the next few quarters are going to be really interesting. Then they start getting under pressure to start spending some of that money and start filling the pipeline with new discoveries. So I think we're just getting into that stage. We've started to see a little bit of M&A activity pick up. I think it's going to accelerate tremendously, and that poses a real challenge because there are very, very few companies out there in the developer space or in the advanced exploration space like a Great Bear for these companies to choose from. So you're going to see things go at prices that we've never seen before, in my opinion. Premiums are going to start increasing dramatically. A situation like Great Bear, which is truly is one of those generational kind of discoveries in a established gold camp where the operators are dealing with increasing mining costs, lower grades, and basically on the tail end of their lifespan, and then they have a project like Great Bear in their backyard. These become things that have to be owned. It's not a want to own them, they have to be owned. And as I said, the universe is very small. There's probably only in the developer space, 7 or 8 projects globally that are fully permitted and ready to go, that are shovel ready. Luckily, we have one in our shop with Bluestone. But I see it's going to be a very exciting time over the next few years. And you're going to see some huge premiums paid. Companies will start acting irrationally, which we can take advantage of. I'm looking forward to it.
Yeah, I would add to that it's going to, once the first big junior mining takeout happens, you're going to see all of those companies that you talked about, the 4 or 5, half dozen or so companies that are tops on the list, they're all going to get speculation into them. And one of the things that this junior mining market has been missing has been a liquidity event, a big liquidity event that's created a lot of money for investors in the sector who then always seem to turn around and reinvest it in the sector, lifts it up, and then that attracts that kind of price performance, brings in more generalist investors.
Well,
so,
on a micro level with Kaminak, that really happened, John. You remember in 2016, the shareholder base of Kaminak, when that acquisition happened, it rained money for those investors, and they redeployed it not only into Discovery Group companies, but other companies as well. So it was a perfect time. So you're right, if a whole bunch of deals start happening right now, or some big deals where money starts getting recycled and aggressively trying to find a home in the next one, it's going to get pretty exciting.
yes,
and we have some interesting dynamics before, like the quant trading.
How would that apply?
Well, just as the gold market starts really getting active, we're starting to see trading activity that we've never seen before that's generated by these quant programs. And then we're going to see the influx of the generalist money, because whether you like gold or not, you can't ignore the revenues that the big gold mining companies are going to be generating here. So, the other thing is I don't think people understand that, there's a serious supply problem when it comes to gold and gold companies. The global gold mining business is only, between a $200 and $300 billion a year industry. So if you start deploying large amounts of capital into the space, you've got a serious supply issue there. So I can see, all these gold stocks really taking off because, there's just not in a global sense, there's not a lot of product to go around.
Yep.
Yeah, it's a tiny market. There's so much liquidity out there. And if it tries to get into this sector, it's like my friend Doug Casey said, trying to fit the contents of the Hoover Dam through a garden hose. There's just prices have to go much higher. And you know, I was talking to another friend of ours, mutual friend of ours this morning about this market and what it compares to. And we look back, you know, even in the early mid 90s, we had companies that were trading for $3, $4, $5 a share that had nothing but moose pasture, just an area play and the like. And that it's hard to imagine now, but that's where this market can go. That's where it has gone. And even though we've had companies that, if you look at the lows in March and April, they've gone up. Sometimes they've doubled or more in value since then. We are still so early in the game, and what we're looking at is companies that are now trading for you know, 20 cents or 15, 20, 30 cents. The base case for companies like these in a different market environment will be $1, $1.50. And if you can find the better companies and deploy capital, be smart and prudent about it, accumulate, try and get good bids in, but build positions in the best of these companies. We're entering a macro environment that will be extremely rewarding for you over the long term, especially if you focus on the better companies. So with that, I think anybody else have any important points they'd like to ask or add to this discussion before we close it out?
And for me, thank you, Brian.
We're all done on brilliance here, huh?
Thank you, Brian.
That was great, Brian.
Well, thank you all. 3 great companies, great executives, a great team with the Discovery Group. Please follow these companies. You can get goldnewsletter.com. You can go see my top recommendations and follow a lot of these companies going forward. So with that, I will thank you all for showing up, and I hope to be able to do this again soon. Thank you.
Thanks, Brian.
Thank you.
Thank you.